Good morning. It's Monday, May 19th, 2025. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. Lots to talk about this week. As a reminder, if there's something relevant that I want to communicate, I will post it on either LinkedIn or X. That's Intra Week. LinkedIn, you can follow me there, Herb Morgan, or you can follow me on X at Herb W. Morgan. This presentation is designed by me. It is designed to be used by you, whether you are an investor or a financial advisor, it doesn't matter, but you are expected to make your own investment decisions. Nothing in the presentation is investment advice. There's no tax advice, no recommendation for the purchase or sale of any security. Everything is strictly informational. The views expressed herein are mine alone. They may differ from the views of CFIA's parent, its affiliates, or other portfolio managers at the firm. Well, let's start with last week. We had a nice rebound in equity prices, very substantial actually. S&P, you can see, up 5% on the week, pretty solid. And guess what? Positive now for the year. S&P 500 up almost 2% on the year. Mid and small cap stocks ran hard, but still just ever so slightly negative. International participated, emerging markets participated, and international still leading the way this year. Fixed income markets gave up a little on slightly higher interest rates, but they're higher still this morning on the heels of the credit downgrade that happened after the close on Friday that we will talk about in a coming slide. And we move into now economic data for last week. Remember the huge spike in business optimism? We call that a soft data, right? Because it's optimism or pessimism is soft versus actual hard data, which are numbers relating to the economy that are specific and measurable. This is measurable optimism. Anyway, small business optimism index fell for the fourth consecutive month. After that big surge, remember the big surge after the election, and now, inflation, unknown stuff around tax, etc., tariff information, all of that combined has sent that optimism down significantly from its high, but still above where we were, well above where we were about a year ago. Weekly initial claims for unemployment came in unchanged on the week, 229,000, right in line with the estimates. Continuing claims also kind of unchish, 1.88, up a little bit, I guess. And that is consistent with a very healthy labor market in the United States. Retail sales up 0.1% in April, backing out autos and gas up 0.2%. Okay, fine. There was that big front loading ahead of the expected tariffs earlier in the year. Then consumers dialed back their purchases of imported goods such as apparel and autos because they front loaded it. So we're not particularly concerned. We still got a rise. But what we see is spendings at restaurants and bars rose firmly again for the second straight month. And because that didn't have any sort of expected tariff impacts, we can conclude that the consumer is still very strong, doing quite well. We then followed that up with inflation data, both CPI and PPI, and the data is continuing to improve. CPI was up 0.2 in April. That's better than the expected 0.3, and the year over year is 2.3, better than the expected 2.4. The year over year for core, right, unchanged at 2.8. But it does look like, in my opinion, you can say, hey, the trend downward in both is now reignited. It's now a reignited downward trend. Then we got confirmation because PPI had actually been rising, which was really not welcome. And that was really contributing to higher inflation expectations, as measured by the tradable break-even rates, the Treasury break-evens that I showed you last week. April PPI actually fell 0.5% and is now 2.4% year over year. Still, all these are still above target. The core, more important, fell 0.4%, and still, though, unfortunately, still at 3.1% on a year-over-year basis. We got 2 regional manufacturing surveys last week. New York State, or Empire State Manufacturing, has been in a slump. No question about it. Actually, it goes back about 3 years. Very few positive months in New York manufacturing. Fell from -8.1 to a -9.2. That was worse than expected. New orders, though, spiked positive, as did shipments. Could this be a sign of something better to come? Maybe. We'll continue to watch and find out. Employment fell, though, and the outlook got a little better, but remained negative. Philly Fed survey, similar to the New York survey, just takes place for the Philadelphia region, rose from -26.4 to a still negative -4. That was better than expected. New orders here also turned positive. So that is potentially signaling a turn higher in these indices in the coming months as the orders get filled. However, shipments there are really quite bad. Employment, though, solid, and the outlook looks pretty good. So maybe, just maybe, things are starting to turn a little bit on the manufacturing side in these 2 regions. We then got industrial production and capacity utilization, ever so slight. You can see that trend going lower there. On the one hand, that's a negative. On the other hand, it's a positive for inflation expectations. Industrial production was unchanged, fine. But capacity utilization is solidly below 80. And why is that good or important? As you stay below this important 80 number, it is interpreted as disinflationary. So I think this is sort of, in a weird way, good, because one of the front and center issues we have that we're trying to fight, and the Fed can't lower interest rates until the battle is won, is this issue of inflation. But then we got just a horrific number, sentiment number, soft data number, from the National Association of Home Builders. Their housing market sentiment index fell from a really horrible 40 to an even more horrible 34. The line of delineation between expansion and contraction is 50, or optimism and pessimism, I should say. So you can see that the residential real estate market for new homes, the builders, its interest rates and affordability and interest rates hasn't changed, and it's not getting any better at this point. Present sales number 37, future sales number down to 42, and traffic is just absolutely at the bottom. So really, really tough. Hopefully there'll be some relief coming at some point. Housing starts and permits suggest it's not imminent. Housing starts were expected to be up 3%. They rose just 1.6% after a huge drop in March. Building permits fell more than expected, minus 4.7%. Single-family starts and permits fell minus 2.1 and minus 5.1 respectively. Then we move on to Michigan sentiment. And, you can see when you see a lot of these, the Philly Fed's horrible, Empire State horrible, but as I mentioned, signs for optimism. National Association of Home Builders, horrible. Leading Economic Index, which came out this morning, horrible. Michigan sentiment, horrible. And you can see why some economists are drawing this sort of recession conclusion, or saying the odds of recession are much higher. And they know that there's legitimacy to that argument. But we have to take this within the totality of all of the data, and it's one of the reasons I'm just not ready to conclude that's happening. Consumer sentiment fell. This is the University of Michigan reading, from 52.2, which is not good, to 50.8. It's the second lowest reading on record. And so consumers are just looking at the inflation. They're concerned about the rhetoric around tariffs. There was also in May, earlier in the month, we still had, the lingering effects of the recent stock market sell-off, which I think impacts people more significantly than it did 20 years ago because of stock ownership being so much more dispersed, right, through 401ks and IRAs, et cetera. Current conditions fell, expectations fell to a 45-year low. That's pretty significant. So if you're looking at the soft data and you want to conclude that the soft data leads the real economy, you would conclude recession's coming. And then you would conclude that the Fed, of course, will be raising or cutting rates sooner rather than later in response to that. On the other hand, I look at it and say, well, look at corporate profits, look at retail sales, look at actual consumer behavior and activity, look at the inflation data, et cetera. It's really hard to get to that recession conclusion. As you know, I've talked about that a lot. Speaking of looking at positive things, earnings were just about wrapped up. 462 of 501 companies have reported. 355 have beat. Only 89 have failed to beat or have, underperformed the estimate. Average earnings surprise a little over 8%. Solid big number, right? Communications, which is a big part of our economy. It was the outgrowth of tech. Tech itself, older tech, I guess, up 5. Real estate, as would be expected, down. Energy, roughly flat, because we want prices to go down. The other two things we got last week that were very, very important. One, the one big, beautiful bill. We had some fun with that, with talking about whether the first comma was appropriate this morning here, but that is how it's printed as it comes out of the House Ways and Means Committee. It's about 47 pages, which I kind of like. It's not a 400-page document, but I want to summarize it for you, what's in there. And it's just come out of the House, right? So the Senate still has time to mess with it, mark it up. The president can sign or veto. There's CBOE, Congressional Budget Office, scoring that has to happen, not CBOE. Scoring that has to take place. So what are the key provisions? First of all, the individual tax brackets that came out of the Tax Cut and Jobs Act of 2017. The brackets we have now that were expected to expire this year are in there to be made permanent. Increase the standard deduction, right? The standard deduction we get on our tax return. And probably the biggest, most consequential to drive capital investment in the economy and to attract foreign capital into our economy is that full expensing of CapEx. That is the big one that's supposed to drive the economic growth and be expansionary. They also want to expand the child tax credit with partial refundability. They left the initial SALT cap in place. That's the state and local tax deduction. But already over the weekend, we've heard that the members of Congress from the states with the high state income tax, like mine, California, New York, New Jersey, are digging their heels in to make sure that there is an increase, and there's already a likelihood that's going to happen. There's likely changes coming from Senate. The child tax credit could be phased in more aggressively. The expensing rules might narrow for some industries. For example, I already got 5 emails this morning from companies saying, hey, buy an airplane, buy a fraction of an airplane. It's going to be fully expensed in 2025 when this bill passes. That might be something that just is just a giveaway to rich guys that might be pulled out. Corporate alternative minimum tax tweaks. And then, as I mentioned earlier, pressure to restore the full SALT deductions from blue state senators. And then, of course, there's the big question of what does it do to debt and deficit? From a static standpoint, like not assuming additional growth, it's estimated about $1.8 trillion increase in deficits, it should say, over 10 years. So call that $180 billion a year roughly. I think it's probably not linear though. If you add in the growth that's expected from the dynamic scoring, they're looking at about adding another $100 billion a year. The debt trajectory, which has been rising, is expected to hit 130% by 2035. Then late on Friday, we got the Moody's downgrade. We'll talk about that next slide. But if that's expected under CBO scoring to add 1.1 trillion, or let's call it 110 billion a year to the debt, what about the savings from DOGE, right? DOGE has already identified 200 billion. Okay. 150 from another 150 from increased compliance, tax gap collection, for a total of about $350 billion. And that is the estimate coming out of DOGE. Whether or not the CBOE will say, hey, we agree, and when they score the bill, they're not going to include that. So you're going to now get the political machines of the two parties spinning this, the Democratic Party, because it's a Republican bill, will spin it as adding to the deficit. The Republican Party, because it's their bill, will spin it as spurring growth. And then I don't think either one's really going to include the Doge as part of it, but there will be some, I'd imagine. But because of that, and we have 3 rating agencies here in the U.S., the third and final, Moody's, finally took away the U.S. sovereign credit rating from AAA to AA1, set the outlook for the nation's debt to stable. The timing of this, I think, definitely related to the One Big Beautiful Bill that came out on Friday. They cited triggers of, hey, federal debt's now at $36 trillion. The deficits are structural, may not be able to be really, not much may be able to be done even by this bill. As it stands, they say, Moody's says we're going to hit 9% of GDP in the next 10 years versus 6.4 right now, which everybody agrees is unsustainable. Or last year, 6.4, unsustainable. We usually had been 2 to 3% before COVID, and then massive deficit during COVID, and then we just kept it at 7% ever since. Obviously, we include trust fund expenditures in those calculations. At first, everybody thought over the weekend the markets would be down a lot today. In fact, as I'm looking at my screen, they're kind of unchanged. The S&P's down 11 points. The Dow is actually up 4 points as I'm speaking. Political spin already from the Secretary of Treasury says, hey, the downgrade is a lagging indicator, sort of punting this backwards to the prior administration. I think the only implication from this is that we'll all be talking about it for the next couple of weeks. We've had the downgrades before, as you know, from S&P in 2011 and Fitch in 2023. Moving on to economic data, we got the U.S. leading economic index, which was down again. It has been just down almost every month now for a number of years. And a lot of people aren't even using the indicator anymore because it always seems to just go down. But I like to put it in there. It came out this morning right in line with expectations. No big data Tuesday or Wednesday, regular initial claims. The May preliminary or flash readings from S&P Global look at manufacturing 49.8. Would be wonderful if that hit 50, right? That's the line, but 49.8 is kind of on the line. Services over 50. Existing home sales and new home sales. Really not a lot on Friday. Earnings season is essentially done, so I think the movement this week in markets is going to come a lot on things people say, whether voting members of the Fed, whether the administration has announcements about, let's say, new trade deals could drive the markets this week. But I think we're already, it's 9:15 in the morning in California. I think we're already beyond the credit downgrade discussions. I wish we would spend more time on the debt and deficit, quite frankly, but that's just me. Thanks, everybody, for tuning in. I will be back to you again a week from today.